If you are thinking about selling your home in the Phoenix area, I'm going to tell you, sellers beware. 4 in 10 listings are failing right now on the market. But there is a little bit of good news for sellers that we will get to at the end of this video. Also, apparently, according to a big real estate investor, buying a home is not an investment. So we'll talk about that opinion as well. Let's get into what's going on today. I'm sorry to say, sellers, that this listing success rate looks pretty dismal. Now you'll see it says 54%. This is only tracking August so far, and obviously we are just starting August. So I'm going to take that number with a grain of salt, but still at 64% listing success rate, we're pretty low on this measure. If you look back just to March of this year, we were at 74% with our listing success rate. This has really come down over the last few months. Last year, the listing success rate was around 71%, so we are now below that, and the long-term average is around 69%. So we've fallen below the long-term average. We'll see how August pans out, but really what these stats are looking like is 4 in 10 sellers are not successful once they list their home. They either cancel it or it expires and they don't end up actually selling the home. So if you are someone who's had your home on the market and it's been unsuccessful, know that you are not alone in that. That is definitely happening out there. Some parts of the valley seeing it a little bit more than others. Also, some differences between single family homes versus like condos and townhomes. In addition to this, you can see that the number of listings that have been canceled on a monthly basis has been increasing each quarter. And we're actually 42% above where we were at last year at this time. So I know that is not the greatest news for sellers, but there is a little bit of glimmer of hope that I will share towards the end of this video. And buyers, this is good news for you because your negotiating power definitely goes up in this situation. If you've been thinking about selling your home and you're just curious what that value is, you can check the description below. I have a link for an instant home value. Now, some of the glimmer of hope for sellers is that our active listings have started to come down. So you have less competition on the market than you did a few months ago. We're sitting at about 24,046 active listings at the time of this video. And we were up to 26,000. I think we were pushing 27,000 at one point in time. So the number of active listings has definitely come down. Some of this being seasonal, some of this just being sellers saying, yeah, this isn't the best time and I don't need to sell. But there's always going to be folks out there that do need to sell. And so if you're in that situation, you just have to remember that buyers are very particular. So we have to price it appropriately. The condition has to be great. And you have to have it, show ready. There isn't really a whole lot of ability to just kind of list it and see what happens right now. So I know there's a lot of sellers out there that are just really hoping for mortgage rates to come down to spur some more buyer activity. So let's talk about what's going on there right now. So according to this article in Housing Wire, the Fed could cut rates in September. Mortgage pros are skeptical of the impact. So there's been a lot of talk about rates actually being cut in September, but they're referring to the federal funds rate. You have to remember that mortgage rates usually follow more of the 10-year treasury yield. So the federal funds rate isn't necessarily going to directly impact what we see in mortgage rates. So last week, the Fed met. They decided to keep the federal funds rate where it is. They held steady on that. But there has been this discussion around the September meeting actually cutting rates at that point in time. In fact, 88% as of Friday afternoon anticipate a 25 basis point reduction in September. Now, as I always say, there can be economic news that affects mortgage rates more so than anything that happens with the federal funds rate. And case in point, on Friday, when the jobs report came out, it came out much weaker than expected. And we actually saw a really big shift in mortgage rates on Friday. So with the jobs report, Logan Motoshami is saying the labor market is getting softer, but it's not breaking. What did the bond market do? There was a massive rally in the 10-year yield, and we will see lower mortgage rates today. He noted that on Friday. Mortgage rates, which tend to follow the 10-year Treasury yield rather than the federal funds rate, saw a slight decline. And we saw a 1 basis point drop for 30-year conforming loans on Friday. So let's take a look at what that actually looks like here. You can see this big drop off on Friday, which is great to see as a buyer and even as a seller. 6.63 for 30-year fixed, generally, of course, depending on your qualifications, et cetera, but that's kind of where we're hanging out now. According to Mortgage News Daily, mortgage rates instantly dropped to 4-month lows after jobs report. Rates tend to improve when economic data is weaker than expected. Today's jobs report was only moderately weaker at the headline level, but it was the revisions to the past months that really got the market's attention. Those revisions removed 253,000 jobs from initially reported numbers. Now, I am recording this video a little bit ahead of the time that you will see it. So this is the latest news as of Friday. There could be some changes in the market Monday and Tuesday before you guys are actually viewing this video. But overall, keep an eye on what's going on with mortgage rates because this jobs report really shook things up and we definitely saw some decrease in mortgage rates as of the end of last week. And I will say, if you are waiting for the Fed to cut rates, that's not necessarily going to be what moves the needle with mortgage rates. So we may see some adjustment in mortgage rates even before September when that decision is made, or maybe nothing happens and then after that decision is made, we could see some shifts and it may not even be rates coming down. So just keep that in mind that when the Fed talks about cutting the rate, it may not mean that mortgage rates are going to be affected in the way that you hope. Now, our team has helped a number of buyers with assumable mortgages, which is a great way to get into a home with a lower rate and payment if you do have the cash that is needed in order to bridge that gap between the loan balance of the seller and the actual price of the home. We'd be happy to talk with you further about this process. You can check the description below to search homes with assumable mortgages or set up a discovery call with our team to talk more about how that works. Now, for years, people have always said buying a home is a great investment. And a big investor with a big name is now saying otherwise. Let's see what he has to say. Before I get there, if any of this is helpful for you, make sure to subscribe and share this with someone who might also find this helpful. Grant Cardone, a house is not an investment. Billionaire real estate investor Grant Cardone warns to stop buying houses. Here is his logic around it. Not new information. Many people do have this opinion, but Grant Cardone has always been a big name in the real estate investment space. So it's interesting to see him coming out and saying this. So he's basically saying that buying a home is an liability, not an asset, because unless it cash flows, you have expenses related to the house. It's going to come with ongoing costs like monthly mortgage, property taxes, insurance, and then of course maintenance as well. For generations, the promise of equity creation and eventual asset appreciation has underpinned the American dream of homeownership. However, in his early July post, Cardone draws attention to the recurring, unavoidable expenses that come with owning a home, which include mortgage payments, property taxes, insurance, ongoing maintenance. His view is that rather than generating income, these expenditures often consume resources that could otherwise be deployed in assets with better return profiles. Now, obviously, we all need somewhere to live. So that you kind of have to think about, does it make sense to have purchased something that I live in and how much additional money may I have for other investments? But he's basically saying that unless you're investing in something like multifamily or, something that's going to cash flow, it doesn't make sense to have all your money tied up in something that is not paying you back. So, of course, I think this really depends on everyone's personal situation. Some people are a little bit more comfortable purchasing a home, dealing with those expenses, using it as a utility and allowing it to appreciate until retirement or whenever they decide to sell. Others may be a little bit more savvy on the investment side, and it doesn't make sense to be keeping your money tied up in something that's not paying you back and rather put it into something like multifamily REITs or, some other types of investments. So to each their own, but I definitely wanted to share that perspective from Grant Cardone. So I did say that there is some a little bit of good news for sellers out there. And we're seeing that a little bit in the CMI. So demand hasn't changed that much. Supply has been going down. We're almost at a normal level of supply. We're at 101.9. The market index being 74.5. So very, very, very slightly creeping up. And what we're seeing is that there are a lot more green arrows across the board on all of the major cities throughout the valley. And the overall change month to month from all of these cities actually was another positive trend this week, which marks week 3 or 4 of a positive direction for the CMI. It was 4.5%. Last week, it was 2.7%. So we are gaining some ground on the CMI. This is largely because that supply is starting to come down. Now, with supply coming down, there has been very little change in demand. However, as we talked about with mortgage rates, if those do actually start to come down and stay down consistently, we may actually start to see buyer demand increase slightly, which is going to bring us closer to balance and instead of a buyer's market throughout the valley. Now, we have a little ways to go on that, but this trend has been a little bit more promising for sellers. We're still seeing the only cities in a seller's market being Paradise Valley and Chandler, which Chandler is barely hanging on. I guess Fountain Hills too at 110.3. We can consider that technically a seller's market. A lot of cities in balance from Cave Creek all the way down to Gilbert. And then we've got Tempe down to Maricopa, all technically in a buyer's market. So we'll keep an eye on this and see if it starts to move more favorable for sellers or not. There's a few moving pieces here as supply goes down and potentially mortgage rates go down as well. Who knows? But don't forget that that listing success rate is pretty dismal right now. 4 in 10 sellers are failing on the market. So it is not the easiest time for sellers. Could that change as we get into the fall? It is possible. But at the moment, just know if you're thinking about selling your home, it's not a cakewalk. Unless you have the most perfect home in the most perfect location, you may be able to see some traction a little bit faster. Don't forget to subscribe if you want to continue to see more videos like this, and check the description below for some free resources that I have. Have a great week, you guys. I'll see you next week on my next market update.